and welcome to our webinar today. This is professional real estate investor David Campbell from hassle-free-cashflow-investing.com, and I am very excited to be presenting today's topic, investing strategies and tax considerations for passive real estate investors. We have a fantastic panel today. I am joined by UDirect IRA President Karen Hall and CPA Amanda Hahn from Keystone CPA. Here's right up front is some contact information if you want to get a hold of us after the webinar or have any comments, etc. This webinar is about creating relationships with you, sharing ideas, sharing opportunities to work with our various different companies. But this is not a sales pitch. There's nothing for sale today. And very specifically, there is no investment, legal, or tax advice. And we're three different speakers from three different companies. We produce a lot of education content together because our topics overlap so much, but each of us have a very separate and distinct companies that offer separate services. So today's agenda, we're going to talk about how limited partnerships and real estate syndications can be a powerful alternative to investing in stock market. We're going to talk about getting all of the advantages of real estate. There's some huge tax advantages associated with real estate and how to get those without the hassle of dealing with tenants and some of the hassle associated with real estate. We're going to talk about how to get the tax advantages of real estate like the wealthy do. And we're talking about strategies to write off some of your vacation trips and some other expenses that you may have that are not currently deductible, how to make some of those expenses deductible. Amanda's got some great myths about real estate tax deductions, and we're going to talk about strategies to pay yourself rather than the IRS. And we've got some great content from Karen about making smarter retirement investing decisions using a self-directed IRA. Here on the screen is a disclaimer that basically says you're all grown-up people. This is not legal tax or investment advice. Make sure that you are contacting qualified advisors before making a decision. Don't sue us. So hassle-free cash flow investing really takes an approach towards holistic investing that is based upon investing less money, less time, and less hassle, and getting more profits. And when you get more profit with less invested, your return on investment goes up. And there's so many investment companies that talk about getting more profits, but they don't talk about the big elephant in the room is how much time, effort, and hassle have you put into the project in addition to the money to get the return out. And so today we're talking about how can I make my real estate investments passive? How can I make them hassle-free? And there's lots of variations on passive real estate investing. For example, a very popular way to invest in real estate without dealing with tenants is being the bank. You can actually lend money to a borrower secured by real estate and ideally first position, and then you are the bank and you're earning a passive income stream. You don't have to deal with tenants or toilets or property managers unless you foreclose. Right? This is not a session on private lending, but there is a great book on my website, hassle-free-cashflow-investing.com. There's a free book called How to Be a Hassle-Free Cash Flow Lender. And I encourage you to download that ebook if you are looking to really understand private lending. Also, there's a webinar coming up in a few weeks, or if you're watching this as a recording, you can go on the same place that you found this recording and look for the recording on the nuts and bolts of being a private lender. That's a great event that I'm hosting with veteran private lender Ken Gain. So if you are a note investor, the tax considerations associated with that, let's say I lent money to Amanda, and then Amanda, being a really responsible taxpayer, she is going to give me a 1099 INT. Amanda, you are our resident tax advisor. Tell me what's this form mean and what are some of the tax considerations of being a private lender?
Sure. Well, the 1099 INT is very simple. It's, I think most of our listeners today have received these from, their local bank where their savings are kept, where their CDs or certificate of deposits are kept. So it's essentially the same as, when your money generates interest income, then you would be issued a 1099 INT to show how much interest you earned for the year. And all you do is you simply take this over to your tax preparer, and they will report it on the appropriate lines of the tax return. Now, the main thing to look at is what is the tax rate that we're paying on interest income. So when we invest in notes, we're the lender, we're the banker, the interest that we get is taxed at ordinary tax rates. Okay, so what that means is depending on what your other income is, your W-2s, other earnings that you have during the year, this is essentially taxed at the same tax rate where all of your other income is taxed at. The benefit of interest income as compared to W-2 income, let's take that for an example, is that interest income is considered investment income, and because it's an investment income, you never have to pay self-employment taxes or payroll taxes on this type of income. So compare that with what you make, let's say, from your active business or from your W-2 job. Your overall tax rate is going to be somewhere between 7 to 15% lower because this is investment income.
That's pretty important, Amanda, because a lot of people just focus on what their federal tax liability is, and they forget about those additional taxes, those payroll taxes, those self-employment taxes associated with their income.
Yes, I love that you say that because I hear that time and time again from clients that are not aware that they're even paying all these other taxes because we're always focused on talking about income taxes.
Yeah. Another big consideration is state tax. For example, one of my favorite states to invest in is Texas, the state of Texas. And Texas does not have a state income tax, but I live in the state of California, which has their hands out for state tax on everything I do. So when I own my Texas rental properties, I'm getting income as a California resident, and then I pay state tax on those Texas properties. But let's say someday I move to Nevada, which does not have a state income tax, and then I own Texas properties. Those Texas properties are going to come to me state tax free. Tell me the state tax considerations around being a lender. Let's say I live in a tax-free state like Nevada or Texas, and then I make a loan in California where the borrower is in California. Am I going to have to pay state tax to California even though I don't live there just because the loan was made in California?
Well, that's a really good question, and it depends. It depends on where your state of residency is. So in that example, if you're a resident of Nevada, then we have to look at the statute of that state. If there's no income taxes, then generally there's going to be no income tax considerations. But as you said earlier, California likes to get their hands on everything that they can. So California has a rule that taxes California residents, first of all, on worldwide income. Okay, so when you're talking about residents or non-residents of California, you're really looking at two things. California will tax you if you, one, are a California resident, or if you're not a California resident, but you have activities in California, which means earning money here, doing business here, having customers here, having sales here, then California also wants to tax you even if you're not a California resident. So it does get a little bit tricky because, in your example, if you were a Nevada resident lending to Texas versus Nevada resident lending to California, that could have very different tax implications.
Mm-hmm. Great. And a great thing about having a good tax advisor on your team like Amanda is you can say, Amanda, I'm considering making this investment. What are not only the federal tax concerns, but the state tax returns considerations? Because what a surprise someone might have if they were a resident of a non-tax state and they were doing business activities in a taxable state and they wound up having a state tax consideration. And so the answer that I heard you give is it kind of depends on what business activities you're doing and what state you're living in. Is that depends kind of?
You got it.
Yeah. So
Yes.
just know that that's a consideration when you are being a lender. But that's also a great advantage for looking at places to invest that are potentially state tax free. Let's talk about the IRA tax reporting considerations, because I know one of the strategies that we're going to talk about, especially towards the end of this webinar, is the nuts and bolts of investing in passive real estate activities using your IRA. So let's say my IRA made a loan to you, Amanda. Let's say I was with UDirect IRA and my self-directed UDirect IRA account made a loan to Amanda. How would I fill out this form differently if my IRA did the loan versus if I did it personally? Because now, from the perspective, I'm the lender. What do I want my tax form to look like if I'm the lender?
Sure. Well, the first thing to keep in mind is you, as a lender, would not be filling out this form. This is a form that you're going to receive from your borrower.
Mm-hmm.
Okay, so when we have money with our bank, we don't fill out the 1099 interest. The bank's going to issue one for us. So in your example, the borrower is going to issue you a 1099 interest to show how much income they paid you. So when they issue this to you, what we need to do is make sure that they issue this in the name of your IRA. So it will say David IRA for the benefit of David Campbell, for example. And the key here is you want to make sure that this is issued in that first box that says payer's name, that's actually the IRA and not you personally. The second one, right below, it's going to say recipient ID number, and we want to make sure that that is the tax ID number of the IRA and not your Social Security number. The reason for that is because with retirement funds, it's not currently taxable, which means that even if you were to get a 1099 on your IRA investment of a note, you would not have to report that on your personal tax return. Okay, and so what we see sometimes is if this is issued incorrectly, let's say that they put this is for David Campbell and they put your Social Security on there, then what that means is the IRS is going to expect to see this on your tax return. If it shows up on your tax return, then of course the IRS expects you to pay taxes on it, right? So we just want to make sure that when you're using an IRA to lend, that all tax documents that you get is correctly issued in the name and the ID of the retirement account and not you. If in the event that you get it and it to you and it comes in your personal name or your personal Social Security number, you simply go back to your borrower or whoever is issuing the 1099 and request that they make a correction to change it back to the IRA as it should be, and you will not have any problems.
I think it's super important to check your 1099 INT for accuracy. And very candidly, most most private borrowers are not going to give you a 1099 INT, but as a lender, I want them to. I want them to report it accurately because they're going to deduct that mortgage interest on their tax return. And if it comes up that they get audited and the IRS says, well, where did this interest income get paid to? Because it's an expense for the borrower and it's income to the lender. Then I want to make sure that that borrower is reporting it correctly. I don't want them to say David Campbell did it when it might have been my corporation or it might have been my IRA, etc.
Yeah, and it's always good to have that conversation with your tax preparer as well. Because a lot of times you get these types of, tax documents and you kind of put it all in one folder and you just, maybe drop it off at someone's office or send it off. And so, yeah, it's definitely important to make sure you're looking at it and that this is money for me or this is money for my retirement account.
So if this is in your name, your tax professional obviously wants it. If the payor, the recipient of the interest is your IRA, what do you do with that form? Because your IRA doesn't fill out a tax return. Do you just crumple it up and throw it out?
Well, that's just a personal preference. Like I said earlier, you're not reporting it anywhere. For us, typically, our best practice is we still request it from our clients. We like to keep copies of these just for support. But yeah, I mean, if you wanted to just, tear it up, shred it, you're perfectly fine to do that.
Awesome. So I just want to be super clear at the expense of repeating ourselves. If this is in your personal name, it's very important to your current taxes. But if it's to your IRA, it's really not going to affect your taxes at all. Your IRA does not fill out a tax form, so this form is just for information purposes. So
Exactly.
being a lender is awesome because you get security of ownership and you're hassle free, right? The advantage of fee simple ownership, or what fee simple ownership is just whole ownership. Let's say you buy a property and you are the owner, so your name is on title. You've got all the responsibilities and rights of ownership, and you're the landlord. You can make this semi-passive by working with professional management, and our company does work with investors who are looking to place capital as a lender. So we do broker private loans where you are the lender and our clients are borrowers. We also work with people that want to own whole ownership of houses. Let's say someone wants to buy a house and rent it out and receive rental income. We can help you do that. Our company develops houses. We build them from dirt up to finished houses. We buy existing houses in bulk and renovate them and sell them out. We also broker houses and other commercial income properties. So when you have fee simple ownership of property, you've taken title to the property in your own name, and in a perfect world, you hire a manager or you self-manage. And so let's talk about the tax considerations of fee simple ownership or whole ownership of a property. You fill out a Schedule E. Amanda, tell us, what's a Schedule E, and what does this form mean to you as a tax professional?
Well, a Schedule E is pretty much just another form that is part of your personal tax return, the 1040. Schedule E base generally is used to report income and expenses of a specific rental real estate property. So in your example, the fee simple ownership. What you do is you can see on the screen here, it basically allows you to list a property by property account of the income, rental income, for example, or any other income, and then the related expenses of that particular property. A few key things to point out is from a bookkeeping or record keeping perspective, you definitely want to be tracking your income and expenses by property. The reason is because, as you see on the Schedule E, the IRS wants to see your income and expenses by property. And so, make it a habit that when you set up your bookkeeping or your record keeping, to do it so that it's consistent with how the IRS likes to see it. That will save you a ton of time when it's time for you to get your documents together to meet with your tax advisor. Mm-hmm. Another key thing that I wanted to talk about, since you have this form up, is a common misconception, or one of the myths actually that I want to talk about, is that as real estate investors, we cannot take advantage of a lot of the tax deductions that most business owners can, which is meals, entertainment, travel, maybe vacation, or writing off our cars. And you can see that on this form there are some of these listed here. So there's car and travel expenses. There's supplies that we can deduct. I would say that most real estate investors I speak to, we all know that we can write off our mortgage interest and property taxes on the rental. We all know that we can write off our management fees, for example, or utilities that we pay. But an overwhelming majority of people don't know that we can also write off our travel and meals and entertainment and all that kind of stuff, because real estate investors are just like business owners. Anytime we incur an expense relating to real estate, we can write those off on Schedule E. Now, you might have a question, say, hey, Amanda, you're talking about this travel and vacation, but I don't see it anywhere on the Schedule E. Where do I write that off? Well, you can see on line 19, it's called Other, right? So under the Other is where we would list all of your other deductions. If you have continuing education, if you're going to real estate clubs, if you're going to seminars, you have educational expenses, they would all go under the other expense, and you can write all of those off as business-related expenses. So that's one common myth that I just want to make sure that all of our listeners today understand, because it's a commonly overlooked tax saving idea.
So
Another one
is if you own a rental property, for example, and you use your cell phone to conduct the business of your rental property, let's say 30% of your use of your cell phone is for your rental business activity, even though you have no other business activity, you're going to say the only thing you have is a rental property, you could list on your Schedule E a percentage of the cost of your cell phone.
Yes, yeah. So if you have a rental property and you're using your cell phone 30% for investing, for this particular property, then yes, you would list it directly on here. And that brings me up to another commonly overlooked tax deduction, which is that you very well could have expenses that are not property specific, right? So let's say I have two rentals, one on Main Street, one on Fremont Street. But then I go to a rich dad, poor dad seminar, and I learn about real estate investing. Well, where do you deduct it? Against Main Street or Fremont Street? The answer is it's really up to you. You can deduct it, there are a couple different ways to do it. You can deduct it against one property or both properties, or if you're someone who's got 10 properties or more, what you can do is instead of allocating it, 1/10 of that class per property, you can simply create another column on Schedule E here and just call it general and overhead or G&A expenses, and put all of those non-property specific expenses in that particular column. So that's more just of a preference in terms of how you want to show it, but definitely understand that your real estate expenses don't have to be property specific. As long as it's related to real estate investing activities, you should be able to deduct it on Schedule E.
Something that's awesome that you're talking about deducting vacations for real estate rental activities, and a lot of people are going to scratch their head at that. But let me give you a great example. Our company recently rehabbed and marketed the sale of about 60 single-family homes in Florida. And a lot of our clients flew out to Florida to do their due diligence on these properties. And when they flew out to Florida and they got a hotel room and their meals and their travel, etc., they were there doing legitimate due diligence on the purchase of a property. But I'm sure while they were there, they had a good time and went to the beach. So is that what you're talking about on how to mix your, be able to deduct your vacations?
Yes, that is exactly what I'm talking about. And this is such a great time to be talking about it because, it's July, the kids are out of school, and so everyone is planning, if not already on their family vacation. So yes, let me give you an example of how that works. Okay, a trip does not have to be 100% business to be deductible. In fact, let's say you're in Florida for 10 days and only one of those days is business related, then part of your trip is still tax deductible. But a way to make most of your trip to Florida deductible is to show at least 50% or more of your trip is business related. So let me give you a scenario. Let's say that I'm looking at investing in some properties with you, David. So on Wednesday, I fly out from Orange County California to Florida, then Wednesday is considered a business day because I'm traveling. Okay, so I get there in the afternoon, I go to the beach or I hang out. It's still a business day, even though all I did was travel there. And then let's say on Thursday, I wanted to mess around. I go shopping. I do whatever it is that I wanted to do. Nothing related to real estate. That's a personal day, okay? Or maybe I take the kids to Orlando, let's say. And then on Friday, we meet at the property. We look over stuff, have a meeting, discuss what the investment is, what the return is. That's a business day. Saturday, Sunday, just messing around, doing whatever it is I wanted to do. And let's say on Monday is when we meet again, and I'm going to sign paperwork, finalize the decision to make an investment, and then I travel back, let's say Monday or Tuesday. Well, in this particular example, even though I really only worked 2 days out of the week, but the entire travel cost is tax deductible because the majority of my working days were business related days. So two key takeaways here. One is if more than 50% of your trip is business related, then 100% of the travel is going to be tax deductible. If less than 50%, then the specifically business related items are still going to be tax deductible.
This is so exciting. People at home should be jumping up and down because if they saw, hey, you could go on a Hawaiian vacation, 50% off, people would jump at that opportunity. And really, the opportunity is if you mix your business with pleasure, you can find this opportunity to basically get 50% off depending on whatever your tax rate is, right? You can get your travel 50% off because you're doing it with pre-tax money rather than post-tax money.
And the other thing to keep in mind too is that as you're planning for your trip, there's so many ways to schedule your days so that you meet all of these requirements, right? I mean, when you're out and about, looking at properties, get business cards, get brochures, get flyers. These are all things that can help you support the fact that you are on a trip for business purposes. I mean, it's not uncommon if you think about it with flights and hotel and food and car rentals. It's not uncommon on a vacation like that to spend $2,000 or $3,000. I mean, if you're that could be a $2,000-$3,000 tax deduction that you get for your summer vacation.
Pretty cool. Amanda, talk to us about active versus passive and how that might be different for ownership of property. And depending on who the investor is, that income could be taxed differently.
Sure. What I love about rental real estate, again, is it's always going to be considered investment income. Okay, whether you do it as a note, whether you do it as a direct ownership, it's always going to be considered investment income. And the benefit of that, as we talked about earlier, is that you are never going to be paying any self-employment taxes or payroll taxes associated with rental real estate. Okay, so that's a huge benefit compared to what you're actively doing to earn your money. Now, in terms of active versus passive income, that will depend on what you are personally doing for your real estate. So it's not uncommon for one person to be passive with respect to one deal and for another person to be active with respect to the same exact deal. Now the question then is, well, which one's better? Do I want to be active or do I want to be passive, or does it matter? The answer, unfortunately, is it depends. If you're in the business of rental real estate, a lot of times, I would say maybe 60% of the time, it's going to be better to classify yourself as active in real estate if you have losses or an excess tax write-offs that you want to use to offset other types of income. Now, when we say the word active to the IRS is different maybe than what you might consider active. It doesn't necessarily mean that you have to be out there swinging a hammer, fixing toilets. It just means that you have to at least be actively managing a property or managing your managers. Okay, so when we say, because I know earlier we're talking, today's call is about passive real estate. But just know that when you're talking to your tax advisor about active versus passive, that's a very different definition. And when we say, you want to be active, we don't mean that we want you swinging hammers or fixing toilets.
So the interesting thing is if you had invested in something and you've taken an active role, there's an opportunity to potentially receive a better tax benefit than if you were passive, or the opposite could be true depending on your overall tax situation. Is that right?
Yes, that's exactly right. You might have someone who has a lot of passive losses from, from investments they've made years and years ago, or for whatever reason, people might have passive losses. In that case, yes, you want all of your income to be passive so that they match up with each other and one can be used to offset the other. So yeah, I mean, it definitely is a person by person determination, and that's part of the strategy and the planning that you should be working with your tax advisor on, to look at ways to shift income or match up income and expenses or income and losses so that you ultimately get the most tax savings year after year.
Yeah, so let's talk about if your IRA purchased a property directly. That's fee simple ownership because it would be you direct IRA for the benefit of David Campbell. That would be whatever the vesting on the title would be. That would be direct ownership of property. My IRA would have direct ownership. How would I report the income and expenses of my property if it's owned by my 100% by my IRA?
That is a really great question. So remember earlier we were talking about if you're lending and you got a 1099 INT, what happens to it? And we were talking about shredding it up or crumpling it and throwing it away. Well, it's kind of the same thing. So if your IRA is invested in a specific piece of real estate, the IRA owns the real estate directly, then you would not even report any of the income or expenses on your personal tax return. Okay, you don't even have to send this to your CPA at all, because they're not going to, well, they should not be showing it anywhere on your tax return.
That's pretty amazing, right? Because you've got this asset that's in your IRA, but all of that income and expenses, they just go into your IRA. We're going to talk about some of the pros and cons of owning property in your IRA a little bit later, but it's important to remember that if it's in your IRA, it doesn't pass through to your personal tax return. The income and expenses don't. So, for example, if your property were creating losses in your and it was owned by your IRA, you would be at a huge disadvantage because you couldn't get those losses from your IRA on your personal tax return because they don't pass through. Is that a fair statement, Amanda?
Yes and no. So yes, if you have losses currently, let's say you invest in a piece of real estate and you suffered some losses. You suffered true losses, let's say. The downside is you don't get to use that currently to offset your taxable income. But the money that you lose in an IRA is still going to help you reduce taxes in the future at distribution time because it's a true loss that you've suffered.
Yeah, so for the example I like to use is when a property creates depreciation, which makes a phantom loss for me, I'm eventually going to pay taxes on that money unless I 1031 exchange till I die. But assuming that I sell that property and realize that gain in my lifetime, I've effectively gotten an interest-free loan from the IRS from the time that I took that phantom loss from depreciation until I sell the property. However, if you have that loss in your IRA, it's the other way around. You've basically given an interest-free loan to the IRS.
Correct.
Yeah.
Yes.
All right, let's move on. So we talked about vacation and travel, and we got a lot of great feedback on that, questions that we probably will have to answer offline because of our time constraints. But if you are watching this as a recording and you want to ask a question, please contact one of the faculty members via email or phone, and we're happy to answer questions. So a general partnership is very much the same as fee simple, right? That you are the co-owner and semi-landlord or co-landlord of the property with a partner. So let's say Amanda and I decide to purchase a property together where I'm on the deed and she's on the deed. I put in some money, she puts in some money. Even if it was Amanda's IRA and my personal money, it's still a partnership, right? We didn't own stock in a company, we own direct ownership of the property. So in that case, let's say Amanda and I own a property together as partners, and we're not married. How do we report that to the IRS?
When we are general partners in a real estate transaction, you basically report it on Schedule E, just like how we talked about earlier. So earlier, when you own it 100% yourself, you put everything on the Schedule E of your personal return. But if you and I own 50-50, then you would report half of the income and half of the expenses on your return, and I would report half of that on my personal tax return. Now, depending on how you are keeping track internally, if you're keeping track internally at 100% of income, 100% of expenses, and at the end of the day you just split it in half, then it's perfectly fine to report those exact numbers on the Schedule E of your tax return. But let's say that the two of us as partners, we like to split everything down the middle. Half of income goes to you, half of income comes to me, half of utilities paid by you, half of utilities paid by me, half of mortgage by you, half of mortgage by me, and that's how we do our record keeping. Then we can actually report it line by line at 50% on our tax return as well. So that's a good thing. It's pretty flexible in terms of how we actually show these on our tax return. But generally speaking, I'm not an attorney, but generally speaking, the tenant in common or general partnership method is the one that is our least favorite in terms of how to hold assets, just because you essentially don't get any type of asset protection, and what your general partner does could have an impact on what happens to your personal assets as well.
Yeah, we're going to talk about the pros and cons of each of these strategies, and this is definitely the type of ownership that I do not recommend. I don't want to be in a general partnership with anyone unless my limited liability company is in general partnership with your limited liability company. And then we've got tenants in common ownership, two LLCs and tenants in common ownership. In that situation, we gain the benefit of asset protection because the owner is an LLC, while getting some of the simplicity of having just a general partnership or tenants in common ownership. A question that I get a lot, and I'm going to put this to Karin and Amanda, whoever wants to field this question: can I create tenants in common ownership or a general partnership with my IRA? Can I have David Campbell own 50% and David Campbell IRA own 50% of the same property?
I can touch on that if you want me to, David.
Yes.
Okay. Well, you're not going to partner with your IRA. There is a special Department of Labor ruling called 2000-10 where they allowed it someone to partner with their IRA, but I wouldn't recommend it. You're not going to tenant in common with yourself. It's just, too many pitfalls of potential self-dealing or personal benefit from your IRA. You don't partner with yourself. Now, there are other, IRA companies that may take a different view of it, but based on what we've seen the IRS and do, what we've seen their, the actions that they've taken, it doesn't make any sense to partner with yourself as tenants in common.
So the way I hear the answer is it's potentially allowed, but there's some huge caveats of self-dealing that make it practically inadvisable.
Yeah, great summation. Yeah, exactly right.
Yeah, awesome. So let's move on. The other great way to create passive ownership of real estate is through group investing, or what's called a real estate syndication. And my company is a real estate syndication company. We do aggregate the funds of multiple individuals that are qualified or accredited investors, and we go buy commercial properties with those aggregated funds. And the advantage of that is it's very, very passive. You basically are owning the equivalent of a stock, but you get the benefits of ownership because you're owning membership in a company, and that company has a very specific business plan to buy a very specific property, and then that partnership and the real estate is managed by my company, by my team. So when you do own shares of a company or membership in an LLC, at the end of each year, the manager, with the help of their tax professional, prepares a K-1, which is a partnership return. So the actual company files a tax return, and then they chop up that tax return and put a summary that they give to each investor. So Amanda, could you talk about what the K-1 is?
Yes. Well, a K-1, the easiest way to look at it is it's just like a W-2. Okay, it basically shows what you earned during the year. The difference being that this is what you're earning from, one of your investments or one of your businesses that you're a part of. I know it looks kind of like a daunting schedule with a lot of lines, very, very small lines, but basically the way it works is let's say you're invested in one of David's deals, and the company made let's say $100 of profit. I know it's much more than that, but let's just say it made $100 profit, and your share of it was $10. And so what happens is you're going to get a K-1 from David or his company, and it's going to show this is your $10 worth of income that comes through. Now, the reason there are so many lines of this K-1 is because when you make an investment, or if you have a business, that entity could generate all sorts of different types of income, right? So if you have money invested with David in a syndication, well, you might get a return of cash flow on your rental income. So there is one line for rental income. But the company might also generate some interest income, because in that same syndicated deal, it could also be a lender to other deals. So if there's interest income, you'll see there's a line here that's going to show an interest income on how much you make. Maybe in this particular year, the property was sold, so you have some capital gains, and you'll see there's another line for capital gains. Essentially, this is a summary view that tells your CPA how much of each type of income you're generating from this particular investment or this particular legal entity, and that way we as taxpayers know where to put them on the specific or on the corresponding lines of your tax return. The reason that this is important is, as we talked about earlier, different types of income is taxed at different rates. Okay, so if you invested in a syndicated deal, your interest income is going to be taxed at ordinary rates. You might have some capital gains income that's going to be taxed at the lower capital gains rates. And so this form will be able to help to calculate all of the appropriate tax rates. Another thing before I forget, I know you have a little note here on IRA reporting. So it's very common if you're using your IRA to invest in a syndicated deal that you're going to get a K-1. Again, the key thing is making sure that the partner's name on the K-1 is your IRA and not your personal name, and that the partner's tax ID number is the number of the IRA and not your personal tax ID number. And again, if you wanted to, which I don't recommend, I think you should still give it to your tax preparer just so they have it on their file, but if you wanted to, you could just shred this up or roll into a ball, because it will not be reported anywhere on your personal tax return.
Yeah, awesome. Awesome. It's interesting. This is a particular deal, was a profitable deal, but there was a lot of depreciation and accelerated depreciation that we elected to choose for this particular property. So even though we made distributions, profitable distributions to the members, we were able to create a phantom loss. And so here's an example where someone had invested $60,000 and we gave them a profitable distribution in this particular tax year, but then we had so much depreciation from cost segregation and other, startup capital costs that we were able to give the client a taxable loss. So if this went into your IRA, that loss doesn't, there's no benefit to that loss in the current year, right? Because this is all depreciation, loss, fan losses. We're eventually going to recapture all those losses. So it's not a true loss, which your IRA would benefit from. But in this situation, the person who owned it individually was able to take that loss and put it onto their return and use it to offset other passive income. Amanda, we get a lot of questions about, can I use passive losses like this to offset my active income? And what are some of the restrictions that'll prevent me from shifting losses from the passive bucket to the active bucket, which is where they have their taxable income?
Yes, and the answer to that question is it depends. There are times when you could use some of these losses to offset your active earned income, your W-2 income, for example. And there are times when you're going to be limited. The key, it's based on a couple patterns. One, how active are you with respect to the business or the investment? And again, we were talking about earlier, active does not mean you have to be fixing toilets in the middle of the night, okay? The second thing is, what is your personal overall income? If your personal combined income is over $150,000 and you have a full-time job that's not in the real estate realm, then it's very possible that your loss is going to be limited, meaning you can't use it currently to reduce your taxes from your W-2, as an example. That's the general rule. There are always going to be strategies around that. One, for example, is, maybe it's a husband and wife team and one of the spouses is stay at home. Okay, there could be ways to turn passive income into active income in order to reduce your overall taxes. Another one that we briefly touched on earlier was, well, what if we shifted active income into passive income? Maybe you're a business owner and maybe you have your business set up where you are not having to operate in the day-to-day. So if we can shift your active income into a passive nature, now all of a sudden you can use this $15,000 loss from this example K-1 to offset that income from your business. So there's different potential strategies or different ways to tweak items or shift things to make sure that you don't lose out on the tax benefits. And yes. I actually don't like that wording. You don't ever lose out on tax benefits, but we want to accelerate the time at which you get to use them. So if we have losses, we have write-offs, we always want to try to use them now rather than having to wait.
Here's a great summary of the things that we talked about today. It's a great chart. So on the left-hand side, we talked about the 4 different asset types that you could own passively: notes, LLC membership, fee simple ownership, and general partnerships, right? Each of those are different forms of real estate ownership and passive real estate ownership. Our company can help you create, find assets that are suitable for you in each of those categories. In the liability column, for example, when you're a note holder, there's very minimal liability because you're just a lien holder. The liability would just be at the point of loan origination, which is when you write the loan. If you violated some type of a lending practice, there might be liability, but the actual ownership of the note is a safe asset. When you own an LLC membership, there's definitely liability protection there, or asset segregation in that type of liability, because you've isolated your losses to the capital that you've invested. For example, if you own an LLC membership and that LLC owns a shopping center and that shopping center has a slip and fall accident, the person who slipped and fell is not going to have the appropriate standing to sue you as the owner of the LLC, right? That's the whole benefit of the LLC, is to create that asset segregation. When you have fee simple ownership, your name's on title, you have full liability exposure. So if you personally owned that shopping center and somebody slipped and fell, they have the ability to sue the owner, which is you personally, and they could go after your personal assets like your home potentially, or your cash, or your other personal property. General partnership is the same as fee simple ownership, you just have a partner, right? So the same liability is there for general partnership as fee simple. The tax considerations we talked about in each of those, and all four of these assets are IRA friendly. I really like notes in IRAs. They're very friendly because the income coming to you is ordinary income anyway, which is what you want to shelter most through the use of IRA. The other benefits, just logistically very easy to own notes and LLC ownership or syndications. Those are very simple assets to own through your self-directed IRA. When you own real property, very possible to do through a self-directed IRA. A little bit more paperwork involved and compliance issues when you directly control the property through your IRA. The advantages of each of those we talked about, and some of the disadvantages we talked about as well. So let's talk about real estate in your IRA versus outside of your IRA. This is a summary slide because we talked about most of these things already, but the profit from cash flow, if it's inside your IRA, that's tax deferred. If it's outside your IRA, taxable. The profit from appreciation, if it's inside your IRA, it's tax deferred. If it's outside your IRA, it's also tax deferred until you sell the property, and you get the benefit of long-term capital gains rates if you hold it long enough, and the potential to 1031 exchange and potentially do what I call the swap till you drop, which is you 1031 exchange till you die, and your heirs, and if you set up your estate correctly, they'll inherit your property with a step up in basis, and then all of those potential capital gains are then erased for your heirs, and you never pay the tax on that capital appreciation. So that's a huge star in favor of investing outside your IRA. Depreciation, your IRA doesn't really benefit from depreciation because those losses don't really offset any other gains. The depreciation or the phantom losses from depreciation, if you own the asset outside your IRA, just personal ownership, those losses can offset your gains, which is has a huge advantage. I'm dancing around here. Use of financing outside your IRA, it's much easier to get financing than inside your IRA. We did a whole webinar. Amanda and Karin and I talked about these topics in a whole different webinar. If you want to go deep on these topics, you can go to my website, hassle-free-cashflow-investing.com. Go to the video section. You'll find several videos created by Amanda, Karin, and I about these topics. And so one of the best reasons to use a self-directed IRA to invest is that's where the money is. And you get the ability to defer taxes or deduct the income that you're contributing to your IRA. Amanda, can you really go into why we want to set up a self-directed IRA in the first place?
Well, yes, of course. I mean, the way I always look at it, or the way I talk to clients about it, is when you look at whether or not to put money into a retirement account, is you're making a decision of whether to pay the IRS or pay towards your retirement, right? Because when we fund money into a retirement account, we generally get a current tax deduction for it. So if I put $5,000 in an IRA, I'm going to take a $5,000 tax deduction. If I put $30,000 in a 401k, I'm going to get a $30,000 tax deduction. So that's immediate tax savings that I get. Now, we know that when we write a check to the IRS, our ROI, or return on investment, is a guaranteed zero. There's no return on investment. There's no return, period, right? It's never coming back to you. Versus if we put, let's say, $10,000 into an IRA, not only am I going to get a $10,000 write-off to save on some taxes this year, but now I have $10,000 that's growing in a tax-deferred account for me from now until the time I retire. And with the ability to self-direct, I mean, if you're a real estate investor, if you're someone who's looking to invest in real estate, it's really just a way to move money from your taxable bucket into a tax-deferred bucket, take a tax deduction, and be able to use that money right back into real estate and have it grow for you tax-deferred, right? So it's, when you look at it from that perspective, it's almost like a no-brainer to want to maximize your retirement contributions, especially if you can invest in a tax-deferred way. And now, you know, earlier we were talking about all the tax strategies and the reporting requirements, and the key to understand is when you invest in real estate with your retirement money, you don't have to worry about any of the reporting requirements, because we talked about several times, you don't even have to report the rental income on your personal returns, or if your IRAs invest in notes, there's no reportable income. And you don't have to worry about depreciation or cost aggregation or writing off all these items, because all the money is already growing for you tax deferred. So it's a really wonderful tool. And I know in the past, or even now, unfortunately, a lot of people either don't understand self-directed investing, or they're working with tax advisors who don't understand self-directed investing. And so what people were doing is trying to figure out, well, should I fund my retirement account, or should I use that to buy real estate? And the best answer is you can do both, right? You can fund an account, fund retirement account, get a deduction, and use that for real estate. So that's the powerful tool. And I think when we talk about how do the wealthy build their wealth, I mean, the two major ones that people look at is real estate and retirement investing.
Yeah, I get the question all the time, David, should I own real estate in my self-directed IRA? And it's a really complicated question, because generally my answer is no, you shouldn't own real estate in your self-directed IRA. But then they say, well, should I have a self-directed IRA? And my answer is almost always yes, of course you should have a self-directed IRA. And the next question is, well, once I get money in my self-directed IRA, what do I do with it? And my answer is, well, you should probably buy real estate with it, right? So you come full circle on, well, you probably should own real estate in your self-directed IRA because that's where the money is. But in a perfect world, the real estate's going to have a better tax benefit for you outside of your IRA. But you're getting such a big benefit on the front end by having that income tax deferral or deduction when you contribute into your IRA at the front end, that it really is a powerful mitigator to make me want to own property in my self-direct IRA. So,
David, I got to throw in my opinion, and I see you got my slide here, so it's good timing. But I say, if you have a retirement account, how is it doing? You know what I mean? And what is it invested in? And what do you think where do you think you're going to get your best return? It doesn't matter. You know, maybe it's real estate. Maybe real estate is what you know the best. And so maybe real estate is the very best thing for your self-directed IRA. We always say invest in what you know best, but you just have to ask yourself, where are you going to get the highest return for the money? Maybe you're not going to get the tax deductions, but if you have any retirement money at all, you want it to perform to its maximum ability. So you're going to invest in whatever asset class you understand the best, is what we say.
So Karin has done a great presentation for us together on the nuts and bolts of self-directing your retirement account. So for the sake of time, we're going to ask her just to hit some of the very big macro highlights. And if you want to go deep into the nuts and bolts and hear the mechanics taught by Karin, again, I encourage you to go to hasslefreecashflowinvesting.com, go to the video section, and there's going to be some great videos where you really get to hear Karin talk with a lot more time, freedom of time. So Karin.
Okay. With that, so self-directed IRA, it's really like any other IRA. The one difference is the asset that the IRA can invest in. So the IRA can invest in anything except life insurance and collectibles. So your IRA can invest in things like, notes, or, which is a nice passive investment, hassle-free, right? You're skipping around a bit there, but we'll hang on. You can invest in private stock. You can invest in tax liens. So many different things a self-directed IRA can invest in. Now, if you want to invest in the stock market, leave it in a typical IRA. But if you want to get into alternative assets, and alternative means not the stock market, pretty much, then you use a self-directed IRA. And I would say probably 95% of UDirect IRAs account holders are investing in real estate. So we can go on to the next slide if you like, David. Again, it's the IRS that lays down all the ground rules for what you can do with IRA money. And I'll tell you what, investing with an IRA is not like investing with your own private cash, believe me. Because when it's your private cash, you can do a lot of things. But when it's a self-directed IRA, the IRS has a lot of restrictions that you may not expect. And we'll talk about them in a minute. But when it comes to what you can do with the self-directed IRA, the IRS in publication 590, they don't tell you what you can invest your IRA in, just what you can't invest your IRA dollars in. And that's a short list. It's life insurance, contracts, and collectibles. Everything else is fair game. So we can move ahead. And we can talk about the fact that if you are currently employed somewhere and you've got a 401k, I say great, because I think Amanda and David will agree with me. The more you can save for retirement, the better. Save away. I think it's wonderful. But if you want to use that money and invest in self-directed, you may not be able to. You probably have to wait until you leave that employer because a 401k, in order to get the money out, you have to have something called an in-service transfer if you still work there. And there are restrictions on who can get one of those. But hey, if you want to try it, go to your plan administrator, ask for an in-service transfer, and go forward. Now, I was saying that if you want to invest IRA dollars, it's not like investing your private cash at all. So you need to have the right expectations, so we'll talk about the rules. IRS.gov is the website, publication 590, you can read it. It talks about the guidelines. So number one, you're not going to borrow any money from it. If we could go back, that'd be great. So you're not going to sell any property to it that you personally own. I actually got an email on this today. Someone wanted to buy an asset that he personally owned. You can't do that. You're not going to use your IRA as security for a loan, and you're not going to use it to buy property for personal use, present or future. Super important. All right, let's go ahead. Now, I don't know of any other situation where somebody can actually be disqualified to you, but in an IRA, your lineal ascendants and descendants are disqualified to your IRA. That's your parents and grandparents and their spouses, you and your spouse. And then your children and your grandchildren and their spouses, disallowed, disqualified to your IRA, plus any fiduciary or anybody providing services to the plan. But the people who are allowed on the next slide will be the people out to the sides, like your aunts and uncles, cousins, brothers and sisters. Now I'll explain what that means in just a minute, but understand some people are qualified and some people are disqualified to your IRA. Okay, next slide. Here's where we put it all into practical use. Prohibited transactions. This is what you want to avoid. You're not going to find this with your private cash. But with IRAs, you can commit prohibited transactions. And it can be kind of nasty because, first off, an IRA does not file a tax return. And so there's no statute of limitations on these. So you could have committed a prohibited transaction 10 years ago, 15, 20 years ago, and the IRS can still figure it out and come after you for the back tax and so forth. So number one, neither you nor a disqualified person can benefit today from the IRA. No present benefit, no personal benefit, no indirect benefit. It's for retirement purposes only. So you have to keep that in mind. Number two, you're not going to buy, sell, or exchange property between the IRA, the plan, and yourself or anybody else who's disqualified. That's pretty self-explanatory. Your IRA isn't going to buy a house your dad owns. Your IRA isn't going to sell a house to your daughter. However, it doesn't say transfer, so you can transfer these assets upon death. And number three, a disallowed person, one of these lineal ascendants or descendants, including yourself, cannot provide goods, services, or facilities to the plan. Here's what that means. If your IRA buys real estate, you're not going to go in there and swing the hammer. They call that an overcontribution of sweat equity. Prohibited transaction, can't do it. Say, for example, you're a realtor and your mom wants to take her IRA and use it to buy real estate. And you think, oh, great, well, I'll help my mom. Who could help her better than me? I'm a realtor. You're a disallowed person to your mother's IRA, being a lineal descendant. Even for free, you can't provide those services to her IRA. So this is where you can get stuck with a self-directed IRA. And so we spend most of our day here at UDirect IRA Services steering people clear of these prohibited transactions, and they can be more complex than you imagine. So if you have a deal that you're looking to put together, give us a call, we'll discuss it with you. All right, so moving on. We've covered most of it, but I think another expectation with the self-directed IRA is who's the investor? Because if you're buying real estate and you've got an offer to purchase and you want your IRA to buy it, you don't sign that offer to purchase. The offer to purchase is not in your personal name. It's in the name of the IRA. And you don't sign it. We sign it on behalf of the IRA. So the parties to this deal are you, and then there's your IRA, a separate entity. Then there's UDirect IRA Services. When I founded the company about 4 years ago, I was looking for a custodian to hold our clients' money, and I chose a custodian out of Nevada called American Estate and Trust. But UDirect IRA Services is your point of contact for everything from the beginning of setting up your IRA to the end. If something maybe you've got a relative who has a self-directed IRA with us and they pass away, and we help you with that. So we're going to help you from beginning to end with your self-directed IRA. Okay, so I think that pretty much wraps up what I'm going to be talking about today. We've got a slide in here about how an IRA can be taxed, and this one here talks about different kinds of IRA plans. So it's not just the self-directed IRA, like a traditional IRA, it's a lot of things. But how do you self-direct? We say it's a three-step process. Open, fund, invest. Open an application. We need some paperwork, $50 setup fee. Let's go back. Number 2, fund the account either by contributing, by transferring IRA to IRA, or by rolling over a previous employer's plan. So once your account is open and there's money in it, then you can invest. And we're going to help you with all these steps. Now, the next slide is where you can contact me for more information. Went through a lot of complex concepts very quickly, so email me at khall@udirectira.com, and I would be happy to help you out and answer any other questions. So with that, I'll turn things back over to David and see if there are any other questions.
Awesome. If you'd like to download the slides from today's presentation and download some powerful free ebooks from today's faculty, you can visit hassle-free-cashflow-investing.com/investor-education. And if you go there, there's going to be, give us some time to get the slides up, but once they're up there, you can download them there. Also, you'll get an email from me, David, at hassle-free-cashflow-investing.com, that'll have both a link to the slides as well as a video recording of today's presentation. And I really welcome you all to reach out to our respective companies if there's something you think that we could do to add value to your investing situation. If you do have a question that you want answered by a specific faculty member, our contact information is on the screen, and you can reach out to us, and we'd be happy to provide you some excellent service. Any final thoughts from our faculty members?
No, but I really would welcome any questions that anybody has at udirect, khall@udirectira.com.
Yes, same for me. If anyone has tax-related, I know we went over quite a bit of stuff. Some of it might have been confusing or seemed complicated. So if there's any tax-related questions, I do invite you to call our office, which is 877-975-0975. And we also have 2 very great ebooks that you can download for free. One is How to Turn Your IRA into a Cash Machine, where it's actually co-authored by both Karin and myself, and we talk about all the great tips and strategies on IRA investing with respect to real estate. So you can check that out and download from our website at www.keystonecpa.com.
Thank you, everyone, for attending today. We do have a regular webinar series. I encourage you to look for an email from me that will announce our webinar for the following week. And I appreciate all of your time, and I wish you the best of success in your investing.